Hello everyone, welcome to Lesson 5. This lesson, we will explore journals, ledgers, and the posting process. These are fundamental concepts in accounting, helping business maintain accurate records and prepare for financial statements. By the end of this session, you should be able to define what a journal is, explain the concept of posting, identifying different types of ledgers, and demonstrate how to post journal entries to the ledger. Let's get started. By the end of this session, you should be able to identify what a journal is and its role in accounting, explain the concept of posting and its importance, identify different types of ledgers, and demonstrate how to post journal entries to the ledger. Recall the accounting cycle we studied previously. The accounting cycle consists of several steps, altogether 8 steps, beginning with identifying transactions and ending with closing the books. Bookkeeping plays a crucial role in step 1 and 2, laying the foundation for accurate financial reporting. Steps 5 to 8 involve adjustment and closing entries, which we will cover in the future sessions. So today we will still focus on bookkeeping, the third step, posting journal to ledger. Transactions are recorded in chronological order in journals. Accounts summarize transactions by type, such as assets or expenses. Double entry bookkeeping ensures that for every debit, there is a corresponding credit, keeping the accounting equation balanced. Before we proceed, let's review some key accounting definitions that are essential for understanding financial transactions and record keeping. Transactions are financial events recorded in chronological order as they occur. The act of recording transactions in the journal is called journalizing. Accounts are categories where transactions are recorded. There are 5 types of accounts: assets, such as cash inventory; liabilities, such as loans, account payable; equity, such as common stock, retained earnings; revenue, such as sales, service income; expenses, such as rent or wages. Double entry accounting. Every transaction affects at least 2 accounts. One account is debited, another one is credited. This allows the accounting equation holds, which is assets equals liabilities plus equity. These form the foundation for preparing financial reports. So what is a journal? A journal is a detailed record of all business transactions in chronological order. It ensures accuracy, provides a historical financial record, and facilitates tracking of all business activities. Every financial event is first recorded in the journal before being transferred to the ledger. The journal is where you capture the debit and credit entries to reflect a transaction or event of the business. Here we have got 2 journals as examples. The table shows a standard format of a journal that each journal entry needs to follow. It includes the date of the transaction, accounts debited and credited, corresponding amounts, and a brief explanation. This process is called journalizing and is the foundation of double entry accounting, where every transaction must balance debit and credit. This ensures consistency and clarity in financial reporting. Here is an example of journal entry. On March 1, 2025, a company received $500 in cash for service. The cash account is therefore debited, and the revenue account is credited and recorded in the journal format. This follows the double entry principle. More examples. Here are some categories of accounts and their corresponding journal entries, illustrating how different financial transactions are recorded. So we can look. The first one is selling inventory for $500. It's a cash sale. Journal entry should be cash on debit side, inventory on credit side. The second one, paying $1,000 for rent. the journal entry would have rent expense 1,000 and cash 1,000. The third one is inventory journaling. The company buy $500 of inventory on credit. The $500 is not paid out yet, therefore it's a debt that need to be journalized. The debit would be inventory because it's asset increase. The credit would have the account payable, which is the liability need to be paid in due course. Number 4, you invested in stock and received a dividend of $500. So in this case, the journal debit is the cash because by investing in stock, you receive dividends as cash format. And on the other hand, the credit side would have the dividend revenue as kind of a revenue or income. Number 5, you take a 200 sale to a customer who pays with credit. In this case, it's your customer pay you on credit. Therefore, it's not your debt, it's your account receivable, which is recorded on debit side. And on the other hand, there is a cash sale counted as revenue, so recording the income on credit side. Number 6, giving $2,000 in dividends to shareholders. In this case, it's different from journal 4. This time you give 2,000 cash to your shareholders, therefore cash goes out, recorded on credit side. And on debit side, retained earnings $2,000 as the company's equity increase. So finally, receiving $4,500 for service not yet rendered. In this case, it's called unearned revenue, and unearned revenue is a liability. Liability increase on credit side as service is not yet provided. Opposite to it would be the debit, which is the cash, because cash is received in advance in order to provide service in the future. So the key points are different transactions require different types of journals to maintain organized record. Accurate accounting principles are used, ensuring revenue and expenses are recorded correctly. Posting this transaction correctly is very important in terms of where credit and debit need to be put, as well as the correct amounts. This would ensure that accurate financial reporting in the future. To summarize, the types of journal are used in accounting to record financial transactions are very systematic. Different types of journal include general journal. This is used for miscellaneous or infrequent transactions that do not fit into specialized journals. Examples are adjusting entries, depreciation, and error corrections. Another one is a sale journal. This journal records all credit sales, transactions, and so on, track revenue earned from selling goods or services. The third one is inventory journal, used for recording inventory transactions, such as purchase, usage, and adjustment. And the fourth, utility expense. This is a very important one because it records all the expenses related to utility, such as electricity, water, and internet. Since utilities are paid monthly, they do not require dedicated journal. And number 5, cash receipts journal. This is another very important one. Record all cash inflows, including customer payments and loan proceeds, and track cash income as well. Cash payments journal. This is the opposite to the one above. Record all cash outflows, including suppliers, salaries, rent, and so on. Next one is a purchase journal. Track all credit purchases made by the company. Help to monitor accounts payable and supply attractions. These journals are very important in terms of in maintaining financial recording accurately and also prepare for the later financial report production. So what is posting? Posting is a crucial step in the accounting process that ensures financial data is properly categorized. Posting, by definition, is the process of transferring journal entries to the ledger. It helps summarize financial transactions by organizing them under specific account in the ledger, which are in different journal ledgers that we explained in the slide above. Once transactions are posted, business can track their financial position accurately. Fundamentally, posting summarizes financial data recorded in the journals and are sorted by account in the journal. Secondly, ensure accuracy. Posting ensures that all entries are properly recorded and that the accounting equation stays balanced. Thirdly, facilitates financial analysis. With properly posted transactions, business can analyze cash flow, expenses, and revenue effectively. And posting is the bridge between recording transactions in the journal and preparing financial reports. Fundamentally, what a ledger is. This is a crucial part of the accounting process, where financial transactions are categorized and recorded under specific accounts. A ledger, by definition, is a system of book where transactions from the journal are posted and grouped into specific accounts. The ledger helps business track the balance of each account over time, such as asset accounts, liability accounts, and also is used to generate trial balances and financial reports, ensuring that financial data are accurate and complete. So in terms of the types of ledger, one is called the general ledger, GL, the main ledger that contains all financial accounts of a company, including assets, liabilities, equity, revenue, and expenses. And these are used to generate financial statements like the income statement and balance sheet. Subsidiary ledger, a detailed breakdown of specific accounts under the general ledger. Common examples include account receivable ledger, account payable ledger, inventory ledger. Information in ledger are important because they are categorized by account types. It can be used to prepare financial reports and provide a clear audit trail for tracking transactions. Here we have two boxes showing the comparison between general ledger and the journal. We have looked at the definitions of these two concepts. Side by side, we can see journal on the right-hand side, a detailed account that records all the financial transactions of a business. This is much basic than general ledger and used for the future reconciliation of accounts and the transfer of information to another key account, which is the general ledger. And general ledger, in summary, is a complete record of a company's transactions over a period of time. It's more summarized than journal, with account categories instead of individual accounts, and documenting changes to the major account types, including assets, liabilities, equity, expense, and revenue. Here we have got an example of a ledger and how it is structured. Each entry includes an account title, date, debit and credit columns, and a running balance. These records help business track financial health. So here we have a journal on the left-hand side, and we have cash ledger. It's only one type of ledger on the right-hand side. There are also other types of ledger. For example, from journal we can see fees earned could be a ledger. Rent expense with other types of expense can be another expense ledger. Each entry includes an account title and so on. It shows how journal entries are posted to the cash ledger, demonstrating the relationship between the journal and the ledger. So if we break down the process, journal entries records each transaction in chronological order, and each entry has a debit and credit following the double entry accounting principle. So if we focus on the cash account, there are 5 cash accounts appear on journals in different dates. On the right-hand side, we want to put all the cash accounts together in order to know the total debit and credit and their balance. The cash account appears multiple times, either receiving money as a debit or being used for payments as a credit. And the cash ledger on the right table consolidates all cash transactions. Each time cash is recorded in the journal, it is posted to the cash ledger. The total balance is updated after every transaction, step-by-step posting from journal to ledger. You can see on the left-hand side, there are 5 cash accounts, and we put all the 5 cash accounts into the cash ledger together and calculate the debit and credit balance. An example of the different accounts that are contained within a general ledger, which are showing in this chart. This is an overview of the general ledger structure, which organizes financial transactions into different categories. The general ledger serves as the foundation of a company's accounting system. It consists of 5 main categories: asset, liabilities, stockholders' equity, revenue or income, and expenses. And underneath each categories, there are some major types of accounts. The general ledger helps business track financial transactions systematically. It is used to generate financial statements at last, like the income statement and balance sheet. And by organizing transactions into this account, it simplifies the accounting information and highlights the main categories of accounting process and information to the key stakeholders to those accounting information. Let's look at some real examples further. This example illustrates 4 financial transactions that need to be recorded in the journal and posted to the ledger. The first one is March 5th. ABC Corporation purchased equipment for $12,000 in cash, and other transactions on April 10th, April 15th, and April 20th. So these 5 transactions need to be journalized. As shown here, this presents a journal, which is the first step in recording financial transactions in accounting. We have got 5 times 2 different accounts because each transaction needed to have 2 accounts to balance them. Next step would be posting journal entries to the ledger, which is a key step in accounting to ensure financial information are handled and organized properly. If we look at those information step by step, the fundamental steps include 4 steps. The first one is identify the accounts involved, which we have done in journals, and locate the corresponding ledger accounts. So look into the journal accounts, we can identify some key accounts. Maybe some are multiple, we need to put them together. And transfer debits and credit amounts and update the balance basically. So these are 4 basic steps. And here we have the process of journaling to posting, as well as the outcomes of the ledger from journal. We have 4 transactions, each have 2 accounts, but some accounts are multiple. For example, showing here are 3 cash accounts. When the 3 cash accounts are put together, because they are all in credit side, the total would be 15,500. But from a journal, there are some other accounts, but none of them are multiple. They are only single occurrence of these different accounts, including account receivable, only 8,000 on debit side, and equipment, office supplies, service revenue, and utility expense. Therefore, they are listed in their corresponding accounting sides, either debit or credit. It is important to notice that ledger need to be balanced, which means the total debit need to be equal to total credit, as we shown in the table above. Ledger balancing, which is a critical step in ensuring accounting accuracy, and when ledgers are finished, the balance need to be checked. Fundamentally, ledger balancing means verifying that the total debits equal to the total credit at the end of an accounting period. This ensures that financial transactions have been recorded correctly and that accounts are in balance. And if they are not in balance, there might be some errors in it, such as missing transactions or incorrect posting. Ensures the accuracy of financial statements before preparing a trial balance, providing confidence that accounting equation should be maintained. And if it's not maintained, as I mentioned, the accountant need to check if there are any types of errors involved. The method to check the balance is quite simple. just to add up the total of debit and the total of the credit and compare the two totals. If the totals do not match, investigate errors such as incorrect recording, omitting transactions, or duplication. And if this happens, an adjustment is necessary. That means to correct any mistakes before preparing for final financial statements. Types of general ledgers, which we have mentioned earlier as well, to sum up again a little bit. The general ledger must include all accounts of a business that will appear on their financial statements at the end of an accounting period. These are known as a general ledger account, GL account. The 5 key GL account types are as follows. That are the 5 types of accounts that we mentioned repeatedly. Assets, liabilities, equity, capital, revenue, income, and expenses. Proper classification of transaction are the main task of accounting and bookkeeping, and then accuracy is paramount in accounting. The general ledger serves as the foundation for preparing for financial statements, including the key reports and statements that correctly and accurately. When and how to combine ledgers. Some ledgers are combined. For example, we had one cash ledger earlier in the example, but we have some different expenses, including rent expenses and wage expenses. When some expenses, for example, can be combined or not. For example, cash ledger need to be combined. Since all cash transactions involve the same account, they can be combined into a single summary entry instead of listing them separately. This reduces redundancy and simplifies the ledger. Surface revenue ledger. If multiple revenues transactions occur, they also can be combined and summarized into a single entry. However, in the example we looked at earlier, only one entry exists, so there's no need to consolidation. Accounts that should not be combined should not be merged, including account receivable ledger. Track money owned by customers. Merging it would make it difficult to track individual customers' payment. Equipment ledger. Track assets purchases like machinery or office equipment. Merging it with other accounts would obscure asset tracking. Office supply ledger tracks expenses related to office materials. Combining it with other expenses would be very difficult to track the transparency in these types of spending. Utility ledger tracks utility expense, including electricity, gas, water bills, and so on. Merging it with other expenses would make it harder to monitor utility cost separately. So you don't want to merge utility ledger with wage ledger, for example. So the key point here are combining ledgers when transactions are repetitive, like the one we did in cash ledger, but also keep ledgers separate when details are essential in order to tracking and understanding financial activities, and also for the future financial analysis. Examples are account receivable, equipment purchase, utility ledgers, and so on. Common posting errors to be highlighted here we earlier mentioned. These include posting to the wrong account. This happens when a transaction is recorded under an incorrect ledger account. For example, recording office rent under utility instead of rent expense. Second error comes from incorrect amounts. For example, error can occur if incorrect debit or credit amounts are posted, which can cause an imbalance in the financial equation. And the next one, omitting transactions. If a journal entry is not posted to the ledger, it will not be reflected in the financial statements, leading to incomplete or inaccurate financial records. Methods to correct errors has some as well, but the best policy is do not make a mistake. But if you have 1,000 accounts and 1,000 transactions for a big company, then sometimes it can be quite difficult to maintain accuracy. There are certain ways to help mitigate the issues. The first one is called reverse incorrect entry. In this method, if a mistake is made, a reversing entry should be made. Cancel out the incorrect entry before posting correct one. The second one is enter correct details in a new entry. In this case, instead of altering previous records, a new journal entry should be created with the correct transaction details. These corrections help maintain accounting balance, basically, and the integrity of accounting record. Here I attached a video link. This video is very good because it provides a very detailed step-by-step guide on how to post to the journal ledger. Watch this with students and help them to reinforce their understanding about posting process. This is a very detailed exercise that students can do in class or at home. The students should record and post all the transactions for a company. This example is Printing Plus Cooperation Access, which is coming from the core textbook, and the answer sheet is also attached to the video link. The task is using an Excel file format, so students can practice using and applying Excel to work on this task. In terms of reading, I give chapter 3.4 to 3.6 of the core textbook. There are also some of the links and further learning materials attached. Don't forget to check out these links. The quizzes and learning resources can be very helpful for students. In summary, journals record transactions, ledgers categorize them, and posting transfer state for financial analysis. Understanding these steps ensure efficient financial management and also ensure future work such as financial reports are well prepared and meet accounting standards and are accurate. So we studied these 4 topics: what a journal is and its role in accounting, explain the concept of posting and its importance. We identified some major types of ledgers, also demonstrated how to post journal entries to the ledger. So that concludes our lesson for today. Thank you for listening. If you have any questions, feel free to send a message here with the video. And I encourage you to review the materials I attached with the students in order to drills and practice. I look forward to seeing you in the next session.